Hi there, everyone. We're into the snowy month of February. I hope you're all enjoying it. This is my first webcast of 2016. And again, we're just reflecting back on what happened at the end of the year and maybe give you some information about why did what happen and what the future holds. Last week, you received the Quincy Crosby letter, economist letter, and hopefully you all looked at that and listened to that. There are certain subjects that she covered, but again, I just want to give you some overall information. Um, we're now into a situation where, we're seeing gas prices going down, and we are about to, according to all various newspapers, New York Times, etc., looking into a situation where we could have a flood of oil from Iran now that the treaty's been signed. So we'll see. A lot of this is speculation, but again, you need to know what's going on because that fuels the market one way or the other, rumors, that type of thing. So what we have here, this is from something called Big Charts, and it's the Dow Jones Industrial Average. And again, if you want further information, you can always look down at the bottom where we footnote it and we say where we get our information. And what you can see here is, the Dow Jones, it was doing pretty good, but you see all jagged situations, and you see now on this particular date, it's hovering 16 a little bit below. So, reminder, the Dow Jones only comprises 30 of United States companies, okay, and that's supposed to be a cross section of the U.S., and it's supposed to give you an idea of the health, if you will, of the U.S. economy. So let's look at some of those 30 companies, and they're not equally represented in this Dow Jones 30, okay? I'm going to give you a couple of companies that are part of it that are quite large, and you can see how they've been affected by this downward turn we're seeing. And the first one to the next slide, because what's the other one that is included in the Dow Jones? It's Apple Computer. And you can see here, very erratic. Apple was always a darling of the market. Part of the reason why you're seeing it down is because they're laying people off in China. And again, you can see, on the bottom here what the footnotes are and where they came from. But again, you can take a look at that. And we've got, let's see, we're into 2016, just a little bit. So we're going back 5 years here. The important thing is it was at a high, pretty close to $140 a share, and now it's dipped down below 100. But in any event, with Apple, we don't really know. They invented the wristwatch, and evidently a lot of people didn't buy it. Being facetious here. Their founder, Steve Jobs, the idea guy, is no longer alive, as all of you know. So it's going to be interesting to see what Apple does. But in my own personal opinion, and that's what I do here, I give you my personal opinion, I tell you when. I think ExxonMobil, you probably see a faster turnaround than you're going to be seeing in Apple unless they, come up with some new invention that everyone feels they have to have. But the point that I'm making is here's Apple, here's ExxonMobil, and you can see how that negatively affected the Dow. And again, there's only 30 companies on the Dow. Okay, and here is an example of what's been happening the last couple of years concerning Exxon. It's over the last 5 years. And the reason I'm talking about Exxon is they are, in fact, one of the Dow 30. And you can see it represents oil companies. And again, we're talking about a high here of $105 per share, and it's gone down to 75. In fact, it might be because things have continued to go down with the Dow, we might be looking at around $65 a share. Okay, so that's just a little update. This is our guides to the market that I do periodically. This information is gathered by J.P. Morgan. but it's not their data. You'll look at the bottom of each of these slides. Remember, you can freeze frame them. You can see where they're coming from. But this is just telling you what happened, as of December 31st, 2015. And obviously, it's flopped over into January 2016. So the first thing that we've got here is that S&P 500. Now, many people say this is a better indication of how markets are going to do because we've got 500 companies rather than the 30 that are on the Dow. And again, people, it's always been the end of the world. I think we know that. It's always been the end of the world. There's always talking heads that'll tell you the end of the world. Freeze frame that. You'll see where this particular information came from. You can see what's been going on since 97 all the way up to 2015. You'll see the up and down. And the big point here is it's very hard to time the market because sometimes when people are all getting out, that's exactly the moment you want to get in. And you've heard people say, geez, if only I had stayed in a little longer, I would have seen that big jump. But I can give you history. I can't give you the future. I can speculate on that. I can tell you what we think is going to happen, but this is reality. Some of you might say, well, that's fine, but I don't have any more money to invest. Yes, you do. You have dividends that are coming out, okay? Most of you have funds that produce dividends. And if you've got any questions about that, because again, I'm speaking to a general audience here, please give me a call and we'll tell you exactly, when the dividends come out. So some of you have required minimum distributions. Maybe you don't need to take it out right now in February. Okay, maybe you can take half out in February and then half out maybe in April when possibly the market's going to be a little bit better. We don't know. But the best thing to do is to not sell if you don't have to in a market that's, going downward, and you can see that way up to the right. You can see the market's downward at this particular point in time. Okay, take a minute to look at this slide. If you have any questions on it, you certainly can email me or call my office. So now we're going to go to corporate profits. And yeah, corporate profits are great. And we're looking at the U.S. dollar. And spend some time here. You'll see it's one of the best hedge, if you will, is the currency of the U.S. dollar. But if we look down to the right, we'll see energy earnings. They're really hurting. And you can see there was sky high. So we're in the odd situation where we're happy, we're paying $1.65 a gallon. That's what I paid the other day. But again, that's great. We've got more money in our pocket. But if we've got investments in 401ks and mutual funds and things like that, retirement money, you're seeing that's affecting, remember that ExxonMobil slide, that's affecting the returns of the Dow Jones. It's affecting the returns of all the energy companies. But we do have more money in our pockets because of the price of gasoline. And this just alludes, and again, freeze frame it. It alludes to what I talked about. When's the best time to invest? Here's the S&P 500, largest U.S. companies. And what we're looking at here is declines, etc. And you can see them. And the interesting point to remember, these are declines in a calendar year, despite average drops of 14.2. Annual returns were positive in 27 of 36 years, because here we go back to the 80s, okay? The best thing if you can do is reinvest dividends. Sometimes you can't do that. We're looking here at 2015. You're seeing it. It's way off to the right. You're seeing, we've got negative numbers here. In some cases, we had negative numbers. For instance, in I think 08 and 09, you all experienced that. There was one point it was down 49%. But again, you're investing for the long term if you're in mutual funds that invest in the S&P 500 and into stocks. This isn't particular types of funds that you would use that you need to buy groceries with. Those, unfortunately, have to stay in banks that you have easy access to. So let's go to one, which, again, is a continuation. And it's the market volatility. And come on, you people know that. Here we are in 2010, the first slide, major pullbacks. We're always going to have pullbacks. Shocking news. Think of the market as weather. It's going to get cold in January. It's going to snow in February. Okay? It's probably going to be hot in July, in August. You need to start thinking of the market that way because you've been with me for a while. And those of you that haven't, this is what we're looking at. Here's major situations where the market went down. We circled those for you. And interesting enough, usually when we have these pullbacks, we have high volatility. A lot of people are selling, when we have this because they get afraid. Most of the people are selling are day traders. You're not day traders, not if you're investing, with me. But again, I wanted to show you this about what the highs and the lows are. And again, way off to the right, you can see, we've downward slide here. Now, this is an interesting slide because it shows the corporate cash as a percentage of current assets. And many of you know, and you can see the cash is going up. But as many of you know, I'm really a follower of Warren Buffett. By the way, if you read his book Snowball, which is a autobiography that he approved, you'll notice the fact that he didn't really start making serious Warren Buffett money until he was 55 years old. And Warren Buffett, his philosophy is don't buy anything unless it's giving a dividend, et cetera, because dividend in his philosophy, they eventually go up. Reason I'm mentioning that is we have the media who's wrong basically 100% of the time, in my opinion, okay? They will say, oh, Warren's got a lot of money in cash, billions. He must be afraid of market volatility. In fact, what Warren Buffett is doing, he is buying back his own shares because his shares have gone down considerably, just like the Dow Jones has gone down. And he doesn't like to have money sitting billions of dollars in money markets because it's only earning about 0.5 point. So what he's buying is he's buying his own shares back, which is going to force the price of the shares up. Okay. This on the right-hand side is the cash return to shareholders. And you can see dividends went lower when we had those market bad years like 08, 09, 10. And then the dividends started going back up. So again, you're seeing corporations, what they're doing is giving you a sizable, nice dividends at this particular point. But again, I think this is an interesting slide. Freeze frame it, and you can read it a little bit more. But corporate cash has a lot of money, and 0.5 point is what they're getting in their money markets, and that's not going to do much for their corporation. And this is just sort of, again, a continuation. It's showing a lot of detail here. So enlarge it, zoom it, characteristics of a bull and a bear. What does that mean? A bull has the horns and it goes forward and up. The bear has claws and it claws to itself. So bears mean bad, down, and bull means going up because of the way the curves of the bull horns. But you'll see here on the in smaller print, unfortunately, on the left, the crash of 29, the 87 crash, the tech bubble, we all remember that, what have you. And you'll see all of those up and downs. We'll see a big recession was in 61. We got 20% market decline in the mid to late 1990s, and obviously the World Trade Center, et cetera, that was bad situation. You'll look at the footnotes to the right, and you'll see those little stars, those sort of diamonds. You'll see where, those are the big declines. Bear market, again, let's look at one of the worst bear markets we could see. October 07, the market was down 57%. Okay, and again, this is the S&P 500. And when we look over to, and that was more or less in the middle, and we look way over to the right, we'll say bull markets. Bull markets, remember what I said, the bull market means it goes up. And one of the best bull markets we saw was October, and that was 1990, okay? And certainly March 2009, 200%. So again, that doesn't mean you're going to get it. I'm only talking about history. So spend some time on this particular slide, read it over. You might have questions. What I'm trying to do is to give you perspective in terms of not having you look at this one particular market and think it's not, indicative of what potentially might happen in the future. And again, just following along, it's sort of like when you're drawn into someone's house and they're going to show you their vacation pictures or they're going to show you pictures of the kids. What can we do? But the reason you're here listening to me is try to get a perspective, right? Okay. Here we go, 1900, all the way over major recessions. You can see that. Those are those gray lines, and like the end of the Cold War and what have you, and things that happen. But it's just a further example. And again, I'm going to be showing you another slide, but not at this presentation. I want you to look down at the very bottom of this slide, and you'll notice the fact that some of this information they received from Robert Schiller at J.P. Morgan Asset Management, okay? And he's developed an even different way to calculate if a market's overvalued or undervalued, and I'll be showing you that in the future. But right now, this is just your standard showing Vietnam War and what happened, the market going up and down and stuff. But we're going to talk in the future about Mr. Schiller because he's worked on some interesting information that could be valuable for fund managers and then also valuable for investors in terms of when things look like we might be looking into a slide. So, again, give me a call if you've got any questions on that, and you can freeze frame it and zoom in and get some, more deal. So here we are, consumer finance, and on the left-hand side, it could be your balance sheet, okay? Your home represents about 25%. Other intangibles, that might be playing cards, that might be rocks, all sorts of hobby things that people do. Deposits, that would be things like savings accounts. You can see pension funds because some of you still have something called a defined pension. If you don't know what that means, give me a call. I'll explain it a little bit. And then other financial assets. That could be like your 401k, okay? And you can see that's developing more and more, or just, extra money that you're saving, what have you, for maybe trips, travel trips, things like that. But you can see where most of the assets are. These are your total assets, okay, way over in the left. And then where we have your liabilities, most people, the biggest liability they have is the mortgage, okay? And then you've got student debt and some other things. But that's why one of the things we try to have people do is to, if they're going to stay in their house, is to get very close to paying off your mortgage when you do retire, so you don't have, a big chunk coming out in mortgages like we have here under liabilities. Mortgages represent 67% of the money that goes out to, pay your existing mortgage. Again, another thing that we saw on the right-hand side, household debt and the service being able to provide that debt. It was really in 09 and 10, it was pretty high, but now it's dropped down because people pulled back a little. They didn't buy a lot of things. They were careful about their spending. They increased their savings rate, so that was all a very good situation. But again, this is just telling you a picture of where things are. And you'll hear this on TV, housing stats. What that means is usually it's indicative of how people feel about the economy. Here we have housing stats, and you can see they were way down in 08 and 09. Big surprise, right? And then they started coming back up. One of the things that people are afraid of is if the Fed start raising the interest rate, which they did just recently, a quarter of a point. A quarter of a point means a lot on a mortgage, and that might, put some people out of the mortgage market. Again, you can take a look at this, see what your thoughts are on it. But most people, and the Fed included, they don't want to snuff out the housing stats because that's one of the canaries in the mine that's going to tell us how the market's going to do. And residential real estate, just going right along with that, you can see for all those colors. I wish they were bolder, but you can see the average existing home, and that's sort of in a teal color. That stands out very much. Those obviously are going up. Remember '09 market crash, what have you? Those went crashing down. So we're looking also of the again, Mr. Schiller, we talk about Mr. Schiller and his 20-year study. Again, we'll talk more about some of the new techniques that he's looking at, but you can forget that for now. But you can also take a look at that FHA purchase only. You know, these are people that small amount of money down. And again, you can see, geez, that's good. Housing prices are up. That's fine. But again, with the Fed potentially changing rates, that can put people out of the housing market. So that's one of the things we're looking at in the economy. And I just want you to know where things were left right at the end of 2015 and then into 2016. So the next one we have is federal finances. And yes, that's the federal government. Okay. And you know, we're talking about budgeted surplus and things like that. And you can look at where we got this information from, again, down at the bottom. But guys, okay, the federal budget spending, okay, take a look at it. What jumps out at you? What is green and sort of a gray color? Social Security, that represents 24%. And Medicare and Medicaid, that's 27%. You're looking at half of the budget that is basically, I mean, sure, you wouldn't mind a Social Security cut if you're on Social Security, right? Where you did get a cut, you didn't get an increase this year. And if you're not on Social Security, go ask your mom and see whether or not she'd be happy with the Social Security cut. I think you know the answer. So part of what, well, you'll hear a lot of noise from politicians, but the big thing is about half of that is pretty tied up in agreements the federal government made with workers. There was an agreement with Social Security. You're going to get Social Security, okay? You are going to get Medicare, all right? So it's very difficult to touch that half of the budget. Can it be touched? I'm sure. But we're going to have some, very smart people trying to figure it out. We talk about defense, cutting it, blah, blah, blah. It's only 16%, okay? The big money lies in those social programs. And here it is. And look down at the bottom, you'll see that, we got this from good sources. So this is where the problem is. Where do we cut? Okay? So, and of course, we're servicing the debt. Right now, the debt is cheap because, the interest rates are low. But what happens if interest rates start going up? It's going to put a greater strain on taxpayers. Now, we can talk a little bit about unemployment. Unemployment right now, according to what's been released in the newspapers, is about 5%. But it doesn't really take into account the people that have just given up. Okay, and here I'm just looking at what the growth is, what have you. You can see we're going up a little. If this continues, this downward trend that we're looking at in January, with the stock prices going down, you're going to have some companies aren't going to be hiring. They're going to say, gee, what we need to do is cut. We need to, watch and see and what's going to happen and what the feds are going to do and stuff. So this affects everyone. And again, we don't know where it is. And there's a whole big political football, as you know, about what we're going to do with the people that, let's say, they're in their 50s and they just gave up. This also puts us on Social Security because with Social Security, a lot of people said, oh, yeah, I'm going to retire at 66, the full age. Well, if you've been unemployed for 4 years, let's say you got unemployed at 58, a lot of people are, taking Social Security at 62 because they can't find work. Okay? So again, it's a snowball effect. Here we have Feds and interest rates. You'll see those high, wonderful years of 2000, et cetera, and, a little bit in that beginning, they look like something out of Utah in their desert. But where we are now, way over to where 2015 is, to your right, you can see the interest rates have been flat basically since '08, okay? And as many of you have heard on TV, different programs, CNN, Fox News, MSNBC, a lot of them. I mean, we had interest rates that were out of the Eisenhower administration in the 50s. Okay? So, again, this is just showing you how long interest rates have been down. Okay? And those good old days, of 2000 plus, we were looking at high interest rates, but the Fed's determination is to not go up too quickly on interest rates because they want people to buy homes. And if, the rates go up, a lot of times that can cause higher inflation, which is something the Feds have always worked not to facilitate. Okay, and here's municipal finances, state and local government debt service. And many of you know this. You can look down again at the source here. We're talking about Barclay Capital, etc. Some of you have looked to muni bonds for your tax-free income or your backup to your savings account, things like that, money you don't need maybe for 5 years. In many cases, again, it depends upon the person, the tax bracket. That's a good choice. Those of you that live in Massachusetts, Massachusetts has one of the highest rated bonds. And Big Coup didn't make the front pages of some newspapers, but maybe you've heard of it, maybe you haven't. General Electric, which is part of the Dow 30 that we already talked about. And as a matter of fact, it's the only one that's still on the Dow 30. They are moving their headquarters from Stamford, Connecticut to Boston. This is major. This is stunning. Very long time ago, they used to be headquartered in New York, and then they left New York and went to Stamford, sort of sleepy, nice town. And we're talking about 800 executives. We're talking about the top peer in management of General Electric. That is going to be a big boom, people expect, to Massachusetts economy because they're not going to go into an existing building. They're going to build things and what have you. Of course, these 800 people are going to have to live somewhere. Right now, they're living in Stamford, Connecticut. It's a long drive. So, again, it's also going to be a big boom to Logan and possibly to southern New Hampshire as well, in terms of where these people work and where they're going to fly out of to do a lot of their corporate meetings. So, again, things are looking good in some states. Things are looking awful in others in terms of muni bonds. Many of you panicked, you remember, because Detroit was going under. Well, they're still around, and now they're talking about the reinvention of Detroit, and it's coming back, what have you. Same thing with Chicago. But I'm not talking about those bonds. You would be invested in Massachusetts bonds, which has a very high rating. Is it appropriate for you? I don't know. You'd have to contact me and we can review it. The biggest thing, we don't see too much about it, but the biggest thing that we now have that possibly could have an effect on muni bonds is what's going to happen with Puerto Rico. They're a territory of the United States, and they're in financial difficulty. So we'll see what happens, but right now mass bonds are rated very high. With mutual funds, you can get into that and to see what effective interest rate you'd have by it's based on your tax bracket. You can call us and we can just tell you what that is going to be. But anyway, did want to bring that up to your attention. And our fixed income securities here follow the line. Asset allocation, always nothing, everything in one basket. Again, you can freeze frame this. This shows the ups and downs, for instance, of high yield. This shows munis. Interesting, look over to the right, 2014, 2015, munis were the top returns. And if we look at 2005 to 2015, we look here that munis, that's a cumulative and then the average. So cumulative over this time period from 05 again to 15, cumulative, you've gotten a 70% return. And munis on average give you 5.5, which is pretty damn good. But if you're in certain tax brackets, it's actually much higher because they're free of, if it's mass, bonds, for instance. They're free of federal and also Massachusetts taxes. So again, it's a good backup to your money market or banking account, but it's, like everything, you don't want to put all your money there. But a good asset allocation program, you can see it doesn't have a lot of those swings. It's right in the middle, basically. So that's what we're looking at. And these are fixed income. These are bond funds. Now let's talk a little bit about China. I understand that there's a new drinking game out, that every time Donald Trump says the word China, somebody takes a swig of whiskey. I can't say if that's true, but that's what I've been told. So China, China, China. It's been said a lot of times. And China, what they have is they have something, it's called YUAN. That is their currency. Okay? We all know the yen, what that is, Japanese, etc. But it's pronounced, the YUAN is pronounced Iwan. Okay? And that is their currency. That is their dollar. What China is trying to do, they're coming to hopefully, to the big table where the adults sit for Thanksgiving, and the adults being England and Japan and United States, what have you. But they want their currency to be traded just like those other currencies are traded. China, as you know, closed their stock market down a couple of days, and they're trying to come to the big table, but it's turning out to be quite a little more difficult than they thought. But we're watching this, and again, how China does affects us, not so much in terms of what they produce. Forget the fact that they're producing and making manufacturing for us, but the fact is they have money and they can't buy most coveted, which is U.S. goods, if they're unemployed. And as you recall earlier, I said that Apple's unemploying a lot of the Chinese. So, and then again, we're going into the global currency. And remember, Yuan. YUAN, and here's where we are with the currency of the world. It's publicly traded, just like it's bought and sold, just like you see the bond market and the various stocks markets. But we're looking at that, and you can see the U.S. You already know that. It's a pretty expensive currency right now. It's about the strongest. Here's China right behind it. But the thing is that Yuan has to prove that it's a good indication that if you're going to buy it, it's not going to fall out of bed. That currency is worthwhile. So we were talking about global commodities. It used to be, look down to the lower right, it used to be about commodities. Oh, well, all I have to do is just be in commodities. I'm all set. Because if I look right up above that, it said gold prices. Oh, yeah, gold does really well when the market goes down. Really? Let's take a look at what happened between 2010 and 2015. You'll see gold is down. Okay, so the market's down, gold's down. We don't see that too often, but that's what we're seeing. Again, you can see the commodity prices, and then you can see on the left-hand side, natural gas, livestock, silver, and gold. You can see where it is. It's more on the negative side, if you see there on the bottom, than it is on the positive. So it's always not one item fits all. What you have to do is each market is different. Each recession is different. Each time period is different. And what you have to do is you have to take a look at the years you have to have in your portfolio, and you have to look at, whether or not it's a strategy that is going to work for you. Okay, and what we're looking at here by asset class. Now, this is stock, and we looked earlier at bonds, but what we're looking at is asset class. And this is all different types of stocks, commodities, bonds, what have you, different types of mutual funds. And you can see in the middle what's light, and you can see that line, that black line that goes through. You can see that what seemed to do the best, and it appears that it does do the best because we're looking at history here, is we're looking at asset allocation, which has a combination of various types of stocks and bonds. When we look at the time period 2000 to 2015, you'll see what that cumulative amount is, and then you'll see what it was per each year annually. And for instance, let's look at that way over to the right-hand side. We can look at small caps, okay? We were looking on an average of about 21%, and then right next to it, we can see the annual amount here with high yield was about 7.9. What we're showing, and that's during that time period that we're looking at, that 15 years. What you're looking at before then, of course, is each year how things have gone. And again, a lot of times large cap values are high, and then it's fixed income, and then sometime it's high yields. But if you look at an asset allocation that again has various types of securities involved, that's going to give you the steadiest return. And again, we outlined that using that black line. Next thing, speaking of that, we're talking about, you can see here, time diversification and volatility. Take some time to look at that. Look at the average total returns. Again, people can't believe it, but the best one is usually comes up stock, but you have to go with the good and the bad. A lot of people can see a 50-50 return is about 8.9, almost 9%. Again, what's right for you? It depends on your age. It depends on your risk tolerance. Spend some time looking at that. This slide is diversification and the average investor. A lot of investors are not diversified. They think they are. They're only in about 3 or 4 different stocks. You definitely need different types of portfolios. Over here, you'll see different charts. You'll see the bond and stock market and different categories, 40, 60, 60, 40, and then the S&P 500. Look at how it's done and how it's recovered from 07 all the way up to 2015. Cash accounts, okay? Not a big surprise here. I went to People's Bank the other day, and I was doing a deposit, and I got a flyer that if I tied my money up for 15 months, I'd get 1% interest in a CD. I know many of you have anecdotal stories, but right now, if you're looking at anything long-term, you might want to consider some other options other than a CD. But again, maybe you need that money after 6 months, and you need it secure. So in your case, maybe that 6-month CD works. So again, take a look at here, and you can see where our sources are, as always, on the bottom. The other thing that I want to take a look at is the power of compounding. And Benjamin Franklin, we all remember him, he said that's one of the 7 wonders of the world, is the compounding growth. Here we have 2017. I'm sorry, not 20. Here we have 1970, way over to the left. And we go all the way up to 2015, of course. What it is, that bottom line, where you see December 2015, you see 228,000. We started with a growth of $10,000 a quarter. That is very good, 228,000, but we took the dividends out. If we can reinvest the dividends, look what we're looking at, okay? $914,000, okay? And that was December 2015. That's the top line. So again, it goes back to what I always say, dividend, dividend, dividend. This couple of slides you're going to see are just where all this information came from. And as always, I thank you for allowing myself and my staff to work with you. Please, if you have not, read Quincy Crosby's e-newsletter. Take your time with this. Again, there was a lot of information. You can freeze frame and spend time looking at that. And I am proud to say that Quincy Crosby will be joining us again for a discussion at our client event, which I don't have a date for it yet, but it's going to be sometime in September, but we've got to work it around her schedule. So again, if I haven't seen you or talked to you or you have questions, don't ask. The guy next door is probably a swell guy, okay? Maybe he's a fireman, and he knows a lot about that. Or maybe, he's a police officer or whatever. But the thing is, if you have questions, I can get answers for you. Maybe not right off the top of my head. Again, I had to get this slide information for you to explain what the heck's been going on in the economy. But give us a call here. We're here for you. Or, better, send off an email, okay? Because sometimes that's a better way, and we can explain things in more detail. Sometimes we can do phone appointments, in-person appointments. So, again, thank you very much for having employed us and my staff, and we'll be back in touch.